All right, everybody, welcome back to the Identity Jedi show. Got another special guest coming up. I have been waiting for a while. Me and Samir have been talking about this. Like, we wanted to have a specific type of guest on this podcast because we had so many questions and topics we wanted to get into, and we finally nailed it. It was like chasing a freaking unicorn, man. Because these I tell you about this guest and the area that he comes from, man. Trying to find these people it's crazy. It's crazy. It's like trying to find a four-leaf clover and a unicorn all at the same time. You will notice the background looks a little differently. I am actually not in my usual spot. I am remote today. I'm in lovely Chattanooga, Tennessee, kind of hanging out. So popped a little phone booth through on a virtual background, so the sound may be a little different, but you guys will be all right. We'll make it work. So you know how we always start off every podcast. Let's get a check-in. Samir, how are you doing? I see you're back with the nice, colorful background and the toys. Like, you're back in your normal spot, man. I feel like everything is good.
Everything is good. You know, if you and I were both in a phone booth, well, first we wouldn't fit. Secondly,
Right.
if we had a phone booth at WeWork, this would have been one, echoey, podcast. So I just wanted to come back home and work from my, use my regular mic and stuff. So yeah, it's good to be back, man. It's good to be back.
Yeah. So I'm going to give for the people that run these, co-working spaces. Hopefully you guys see this. Listen, you're missing out on a huge opportunity. Like, make a podcast recording rooms. Like, these phone booths, I get it. Great for conference calls, but like, everybody does podcasts. Just make like through two little sections, two little rows, podcast recording studios, make it happen. There you go. All right. There's my pitch. We'll see if they get to it. Doubt it. Maybe I'll just have to build my own. So let's get to this week's special guest. It was about a year ago, Samir, like you and I started, kind of looking at the market and talking about this and like throwing back some ideas. And we said, you know what? It'd be great to talk to a VC about this. And like, how do they look at this? What do they think, right? Because I'm not from that world, right? You're not from that world. And we just kind of see things. And so we spent the next year like trying to track down and find a VC to talk to about this. But you know how we do on the show, right? It had to be a special type of VC. They had to be cool. They had to be fun to talk to, right? And they couldn't just be some stiff person who all talked about numbers. We didn't want any of that. That's not how this podcast goes. So Luckily, I run into Rama at an event in Vegas, hanging out, having a good time, talking about identity. I was like, dude, you got to come on the podcast. He was like, dude, absolutely. I'd love to come on the podcast. I was like, all right, I'm going to hold you to it. And then I text him just about every day until we made it happen. So Rama, man, thanks so much for coming on the podcast. Welcome. We're glad to have you. Go ahead and introduce yourself. Tell people a little about your background, and we'll jump right into the pod.
Yeah, what an honor and a pleasure to be on the pod. I've been looking forward to this for a long time. You mentioned that story in Vegas. We were at Black Hat, and what's serendipity? I mean, we both got oversubscribed at a dinner, and we were the ones. It was like being in grade school and playing musical chairs, and we were the ones without a chair. Most people would have bounced, but David and I and a couple others just literally stood in the restaurant next to the people sitting down, and it was the most fun and actually the highlight for me from Black Hat, since we got to meet and had a great conversation about everything from identity to VC, and I'm sure we'll cover those topics today. But it's great to be here. My name's Rama. I'm a partner at Menlo Ventures. I'm sitting right now in our office in Menlo Park, California. Originally from the East Coast. I'm a New Jersey guy, so I'm a Yankees fan. Go Yankees. I got to get that out there. And I'll tell you about my journey as we get into the conversation, but the quick background on me is that I'm an engineer by training. I worked at Cisco early in my career, was at another firm called Norwest Venture Partners for about 15 years before joining Menlo this year. And at Menlo, I focus on cybersecurity, Series A, Series B investing. And, I've got two little kids in California here and, got family back east and here in California. So that's kind of me in a nutshell.
All right. Well, ladies and gentlemen, this will be Rama's last time on the podcast because, as you all know, I was born and raised in LA. So, of all things, the Dodgers. And so, we got this whole Dodgers Yankees thing going on. So,
let's go.
Rama will never be back. So, enjoy this podcast episode while you can. Just totally kidding. But no, that's awesome, man. That's awesome. But I definitely, the background definitely interests me, right? Like the engineer turned VC. That's pretty awesome, right? Because that's, similar. I'm not VC, not saying if I ever will become one, but, it's always nice talking to other people who have that same path. Right? I started as an engineer, and then you kind of wind up somewhere else. I always tell people it's funny. If I were to go back in time and meet my 23-year-old engineer self, he'd look at me and go like, who the fuck are you? Like what? It's crazy. How much you you change and see. And it just goes to the, I think engineers can do anything. So that's
Yeah, yeah.
just how I feel about it. I'm not going to apologize about it.
I
Amen.
think
Amen. I mean, I think the engineers, particularly for me, I started life out as a sales engineer, and I was doing that at Cisco. And if you don't know what a sales engineer, sometimes it's called a systems engineer, or these days a solution architect, or forward deployed engineer. There's all kinds of cool terms for it now. But when I was doing it, was a systems engineer or sales engineer. And I was actually quite reluctant to kind of take that job at Cisco because I had done 4 years of computer engineering, and I was like, I got to go build stuff. I got to write code.
Yeah.
And you're not actually building and writing code when you're in the field. But the best thing, that ever happened to me in that role was learning sales. Like nobody teaches you sales in school. There's no sales course, there's no sales major, but everything we do, even in my job in venture capital, the startup founders we're talking to, it all comes down to sales. So whether you're selling the product, you're hiring people, you're raising money, you're selling the company. So for me, yeah, it was engineering background, David, but also the sales, the rooting in sales.
Yeah, absolutely. Samir, go ahead, man.
no, I was just gonna say that's I always break up core values in a company to baking the bread or selling the bread. Everybody in the middle has to fight for their budget, including CISOs many times, right? And so it's really interesting you said sales engineer because that's a combination of bringing your builder mindset to the sales side. I didn't even know, and maybe I'm just dating myself, but the sales engineering role kind of evolved, right? Because pure salespeople needed someone they could partner with besides just opening the door and creating a funnel to help explain technical concepts to technical buyers. Is that fair? How sales engineering came about?
Totally.
Maybe
Totally. I
just
had great mentors, if they're out there, Pat Kirschel at Cisco, Seren Vias. These guys, took me under their arm and told me, look, you're the trusted advisor. The sales guy over there collecting orders by the fax machine in those days, I'm dating myself, nobody trusts those guys, right? You, as a sales engineer, are going to be sitting with the customer, training them on our products, teaching them, and that key word, trust, right? Become their trusted advisor rather than a salesperson. And that really kind of resonated with me because even today, as I think about my job investing in companies, taking a board seat, I use that same word, trusted advisor. Like I think, I think it's a falsehood that the CEO works for the board. I think the board works for the CEO and the founders. And that word trusted advisor to me, it takes a lot to build trust over the years and with somebody. But once you have that, it unlocks communication, unlocks collaboration. And it all started with that role as an SE. You're totally right, Samir. I mean, it starts, look, what does an SE do? They are commissioned salespeople, right? But their whole job is to make sure that the technology works when you put it on the customer site, right? And that goes for SaaS companies, networking companies, security companies. And I think if you look in the boiler room of most successful companies, there's an awesome SE team at the heart of it all.
Yeah. I think we can have a whole podcast on this because I was going to get into. So my sister-in-law works at Okta as a customer success engineer, and it's interesting how that engineer mindset has parlayed itself not just from kind of guys who sit in a room and write code, all the way to like I'll sit with you at your kind of with you to make sure that the product that can be manifested that you want it to be manifested into, whether it's no code workflows or whatever, right? But yeah, I digress. This is awesome, Rama. I mean, and you got on the wave at the right time, I think, right? I mean, because now it's indispensable to not be customer facing and be technical. I mean, now you need both. I feel at least.
I think so. I think so. But it sparks a good debate, that we think about as investors. Like, we actually want to invest in product-led growth companies that don't need an army of SEs to go sell this stuff and integrate it and create a bunch of last mile work because that's expensive, right? Those are expensive people to hire and it takes a lot of time and adds a lot of time to sales cycles. So there's a big debate whether PLG is real or, especially when it comes to security, there aren't many companies that have really kind of done, like when I think about product-led growth, I think of companies like Datadog, for instance, like companies that really excel at getting a product in the hands of practitioners rather than waiting for the golf, course sale or the steak dinner. That stuff might still happen, but hopefully by the time it does, the product's already in the hand of the practitioners, whether it be in the SOC or in the data center or in the DevOps team. But PLG, for us as investors means lower CAC, cost of customer acquisition.
Right.
A lot of SEs is a lot of CAC. So there's a debate on this,
Yeah.
Yeah. Oh man, we're Perfect segue. We're going to get right into it, and careful with those steak dinners and golf course trips, man. We're going to have a lot of salespeople mad at us if we're taking those away, right? That's their thing. But yeah, I want to let's dive into that mindset and talk about that debate. When we look at specifically, I'm going to come from the identity perspective, right? But you could apply this to most security or even tech. When you look at where the industry is, right now, right? Customers' budgets have shrunk. So what does that mean, right? We're hearing that a lot. Oh, economy's tight, blah, blah, blah. CISOs have, tightened the purse strings. So what does that mean? That means that from the organization's perspective, they're looking at something and values at the top of their mind. So they're looking at like, what am I paying versus what am I getting, right? And how long? And not say they didn't always look at that. They did, but it's so much more important now. So to your point about you're looking at companies that it's like, okay, well, I got to look at value, also time that I'm investing. And if I'm spending months going back and forth and doing POCs and all this stuff or whatever, and I'm seeing how this thing comes together, I got to take my resources who are already overspent, have them look at this product and try and figure it out. They're looking at this as like, man, like, and once I get this thing in, am I going to be able to implement this thing? Is this going to even take more time? And so that ability to, get this in front of a customer and say, okay, look, here it is. We're going to show you the value. Let's get it to you as quickly as possible and get you actually solving your problems faster is a key thing on the top of customers right now, the way they look and want to purchase. So there's a concept, the context of like where we are right now in the industry. So from an investor standpoint, right, what are the things that you guys look at that says when you're looking at these companies and going, yeah, they're going in the right direction. This is what we value. Like, yes, 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 right? And you start making it rain. Like, we're in something I won't mention about King of Diamonds. But anyway, you start saying, listen, we believe, like, here's a check. What does that look like for you guys?
Yeah, it's a great question, and it's changed over time, right? To give you some history, Menlo Ventures, for instance, has been around for 47 years, right? And what we've looked for over those times, the way we evaluate companies has really changed. Excuse me, even in recent history, go back to sort of like 2020 and 2021 in this so-called, ZIRP, zero interest rate environment, it was all about growth at all costs, right? And VCs were piling money into companies and not really looking at burn rate, right? It was like, you got to be able to triple, double, double. That was the mantra. It's still the mantra, but now it's like, okay, do that, but do it while controlling your burn. And nobody was talking about this in 2019, 2020, 2021. And then all of a sudden, we hit the brakes and we were like, whoa, these companies are spending way too much money to grow as fast as possible. Now we start talking about burn multiple, which is an easy way to calculate, okay, how much new ARR or revenue are you adding per year and how much are you burning? Get that close to 1-to-1, right? So for every dollar you burn, you add $1 of revenue. Most companies, when they're in growth stage, are way further away from that metric, right? Like a 5-to-1 ratio or 3-to-1 ratio. So what we're looking for is efficient businesses, and sometimes startups are very inefficient, which is why they come to us to raise money in the first place, because they need capital to get started. There's a lot of SaaS metrics. You can kind of put your financial engineering hat on and kind of look at CAC and LTV ratios and growth and burn multiple, like I mentioned. At the end of the day, we got to start with products. When it comes to identity and understanding, where Okta left off, identity is the new perimeter. Like, what is the new security? How is security moving? Organizationally, from the CIO to the CISO, identity becoming a real security topic, right? Which you guys know well. You guys know a lot about. We're seeing this too, and we're listening to customers and trying to figure out where are the sort of tectonic shifts, where can we place our bets so that we can take advantage of these dislocations in the market. And we used to say, hey, grow, grow, grow. And we kind of looked the other way on burn. Now it's like grow, grow, grow. But we're gonna make sure that we're not lighting money on fire. So I think that really changed especially over the last 2-3 years.
Yeah, definitely. It makes sense. And it's interesting having been, in my history, like been a part of both sides of that, right? Being at product companies where it was just, literally we were just, it was grow or die, right? Like grow at all costs. It doesn't freaking matter. Just grow, just grow, just grow, just grow. Right. And, being in the company right in the middle of when that shift happened at a company, we're in the market to sell. Right. And like, it was like 1 week, hey, these are the financials, these are the models that we're judging you on. The next week, completely on its head. Like, oh, your burn rate's really this, you're really this, and we just watched that valuation like just drop like a rock, right? Which was interesting. One of the patterns that we've seen in the identity market and general security market, you've got the big companies out there like Thoma Bravo, right, who just went on a spending spree the last couple of years, right? So billions of dollars buying up these not little, but buying these companies, right? Specifically in identity, they got Ping, they got Cellpoint, ForgeRock, right? So you've got all these companies and trying to basically build this looks like artificial platform, if you will, right? Whether or not they'll merge all the companies together, no, they did take ForgeRock and Ping and merge those together. I think Cellpoint's going to say its own entity, but you see these bigger investment companies spending billions of dollars to kind of get these companies together, right? Because the market, right, from the product perspective, in response to okay, tightening purses, give me value quickly, said okay, well, we can't just do one thing, right? Now we've got to do more things for you, right? I'm not just going to come and clean your windows. I'll clean your windows. I'll clean the inside of the house. I got to keep giving you all these different services. Why? Because you need value for what we're getting out of this product. So you've got product vendors saying, we've got to consolidate and turn into platforms. You've got investors coming in saying, cool, we'll buy these companies up and then do these offerings. And so one of the things that, that the hypothesis that I came up with and me and Samir would debate the last year was, so we see this happening at that level. And so now we see all these kind of what I call like these mid-market players coming in, younger companies, SaaS only, a lot like Okta, right? But they're tackling IGA, they're tackling PAM, they're tackling non-human. But they started in a time where it was all best of breed. So they're like, we just do one thing. Now it's like, but we're in a market where we need multiple things. So my question has always been, as a VC, if you look at this and go, okay, well, Thoma Bravo's doing this at this level, but hey, I can go get these three companies at a tenth of the price that Thoma Bravo paid and get a similar kind of growth valuation. Like, is that like a real, is that crazy talk, right? Or like as a VC, if I say, hey man, like here's these 5 mid-market companies you can go buy for 200 million and do that. Like, is that something VCs look at and go, makes sense?
I think it's a great question. It's worth sort of like, explaining the lay of the land, right? Private equity, VC is a part of private equity technically, right? We are sort of a form of private equity, but with the traditional private equity players you're talking about are much different than what we're doing at Menlo and most VC firms are doing. First and foremost, their fund sizes are way bigger. Like we're investing out of $1.5 billion, which is a lot of capital. Most those private equity firms are investing tens of billions of dollars. So what they're looking for from a return perspective is actually quite different. Like you take what we're doing most often and look at our history and the history of venture capital, most of the returns in a cycle or in a fund come from one or two companies. For us, at Menlo, it was companies like Uber and Roku and Chime historically, and more recently, companies like Abnormal Security, in the email security market. One or two of those companies in a fund are going to drive most of the returns. So we call that the power law. And it's not just us, most venture capital returns are concentrated like that. And the way you make that work is that we have to take a lot of risk, investing in earlier stage companies where we might lose our money. We're investing 10, 20, sometimes 40, $50 million, and we might lose money 2 or 3 times. You think about the analogy, the baseball analogy going back to the Yankees and how they're going to beat up on the Dodgers. You take 10 at bats, we kind of, pencil in, 3 strikeouts out of 10, maybe 2 or 3 singles, hopefully a double and a triple, but you got to have 1 home run and hopefully 1 grand slam in those 10 at bats. If you don't, the math doesn't work for most VC firms, and the best VC firms, the ones that have really endured the test of time, being around for decades like Menlo, have really kind of proven that, if you can get into 1 or 2 of those companies in each cycle, you can continue to kind of deliver outsized returns. Now, those private equity folks you're talking about are playing a different game, right? Usually they're not looking at, for us, a 7 to 10x return is kind of what we would love to underwrite a Series A investment to, right? 7 to 10x our money. In order to get that, we're going to take some risk and actually, lose money like I was talking about. But those private equity firms don't lose money. They shouldn't lose money, right? They're investing in bigger companies, usually longer in the tooth, like older security companies. You mentioned a few that have gone private, but there's a lot, CyberArk, SailPoint, Proofpoint. A lot of these companies end up going public. Their growth slows. and they end up getting taken private by these private equity firms. And it's actually a good thing because it's a financing event for these companies. It's a chance for them to actually right size their financial structure. A lot of the private equity playbook is to go in, oftentimes cut costs, right? Increase the profit margins, increase EBITDA percentage, and make the business more healthy. So it's a kind of evolution of like if you think about us starting at the baby, startup investment time frame, a company hopefully goes public and hopefully stays public and keeps growing for years. But a lot of private equity firms, run that playbook where they take those cash cows and take them private again. So it's almost like this full circle of life, right? But what we're shooting for in underwriting, is a much higher rate of return or much higher cash on cash return than those much larger private equity firms. They're great at what they do, but it's a very different playbook.
Yeah. I was going to say
Makes
that
sense.
they definitely like to cut the steak dinners and the golf memberships when they come in, the private equity guys.
I was just going to add too, to finish the thought, on, what we're looking for and these platform plays, David, you were kind of describing, no company starts out as a platform, right? If you look at like Proofpoint, for instance, they sell a little bit of everything. It's like the tool belt, approach. And Cisco, they've got a little bit of everything. But these startups have to focus, right? The focus is key. And most successful security companies will start with one product and get to 100 million in ARR on that one product before thinking about product 2 and product 3. And if they're successful, they can kind of add on to that first product and find that wedge. And the hardest part about my job is to figure out, hey, is this company that's sitting across the table in this room a feature or is it a company, right? And they all start as features or wedges, or footholds, but that's the hardest part, to squint your eyes a little bit and figure out, boy, it's a cool mousetrap, but can this be a platform one day? Can you build on top of this, right? And I think that's really kind of the hardest part of the job.
Yeah, I was just going to add, going back to the private equity discussion, right? So when David and I met on this topic, I want to say almost 9 months ago, what we were thinking was that, is there a private equity company out there, maybe not VC, that would take these smaller, product companies, not the big ones like SailPoint, not take them, private from the stock market, because we also saw people burning a lot of money with products that could have been considered a set of features that don't really have, synergy maybe, right, with the rest of what the customer needs. So we're looking at saying non-human identity, PAM. How can we build a faster, cheaper, easy to deploy, maybe less on the sales cycle version of SailPoint, right? Or version of Savient or version of ForgeRock, right? And I think you're right. I think VCs would probably stay away from that because it's a different playbook. But if a PE was listening when we were talking last time, David, you could actually do well because what was happening then, Rama, I think it's happening now as well, is that people are tightening their belts on spending on a lot of events. But back then, I remember we saw a number of companies spending a lot of money having people show up at the parties at RSA who were not economic buyers. They were just there to kind of learn a little bit, go back to their team and tell them, oh yeah, I met this company, I had a few drinks. For a small company to have a 6-month sales cycle is actually like not an ideal thing. And I've been there at Balkan ID, right? So we were just pontificating and telling VCs, we'll give you free advice to go and buy 3 companies in identity and make something of it.
To me, I start with my training as an SE, and I'm talking to customers a lot. We have a CXO network at Menlo, which consists of CIOs and CISOs, and I go to them and try to figure out what their priorities are and what they want from the market. And not one of them wants yet another vendor, right? To a security vendor, right? They've got enough. Sometimes dozens of vendors, especially in larger companies. So to your point, Samir, yeah, I think customers do want to buy from less vendors. The question often becomes, all of these startups are essentially kind of punching a lottery ticket, right? That they're going to be the next big identity security company or security for AI company or, XDR or whatever it might be type company. And if you put 10 of them in a basket, you kind of 10x the burn, right? Going back to that. So you kind of create, this opportunity maybe to kind of find synergies and start cutting, but it's just not a playbook that historically has been done for startups. It's more done with mature businesses that have some reliable cash cow, right? Rather than these small startups that are selling a bunch of features. It's an interesting thought, exercise, but I think the biggest hurdle is going to be how do you do that without, you know, multiplying your burn, by each company that you kind of mash together. But it's an interesting thought exercise.
I was just going to say, I had a follow up on that, Rama. So, David and I were talking right before you joined the podcast, right? We're talking about how many companies are attacking the same thing in identity, for example, right? So we all look at it and say, okay, we're going to go after IG, for example, or PAM. Let's use PAM as an example, right? And now we've got, over the time that David and I have been doing this, we've seen so many companies being funded from the US, from India, from Israel, from internationally, right, etc. Now, my question to you is, if I show up at your front door, knocking on your door and saying, hey, I want to build a privileged access management company, right? And I'm going to do it a little bit better. It's going to be a little bit better mousetrap, as you mentioned, Rama. And as you mentioned, some of these might be considered now features or product lights, not really an end-to-end platform, right? I sometimes wonder the team might be great, right? Very sharp people. The area might have opportunity, right? But do VCs look at it and say, well, there's already 10 players in this market. What's number 11 going to do differently, right? Is that kind of, does that play into your mind when you're kind of making these investment decisions? Because we're seeing so many players right now. We're like, somebody's going to die, right? We just don't know how they're going to die, but there's just a lot of players. So how do you look at that?
Yeah, look, I think there's over 2,000 venture-backed, cybersecurity companies, which is insane, right? To kind of throw more money after this problem, when we could be investing in healthcare or AI or SaaS or other areas, gaming that we are investing in at Menlo. So why invest more into this category? To me, it comes down to first principles. The problem is getting worse. Hackers are, still getting their job done, and the good guys are losing this battle. So budgets are going up. There's, M&A, activity in the space. So from like an investment perspective, it's still healthy in terms of like that unfortunate circumstance that is at, most customers' doorstep. I think when it comes to like what we look for, I'll meet 1,000 companies a year and invest in only 2. So you think about like what we're looking for, and what we typically do diligence on, it always comes down first and foremost to team and market. Team, like, is this the best team that can go execute and pull this mighty mission off, right? And we oftentimes call that founder market fit. You've heard of product market fit, but we call that founder market fit. Like, is this team, are these co-founders unfairly advantaged to go out and execute on this vision? Do they have a vision that's different? Or do they have a vision that's unique? Or do they have an ability to execute that's unique? And if we can't say to each other, this is the best team or one of the best teams to go out and execute on this, we don't even get to product and competition and market sizing and all that stuff. I think when it comes to market, we want to know, is this a big and growing market? It's not a McKinsey study on like, a very specific market size that we're looking for, but is this a big and growing market? Or is there something happening in this market there's like a major dislocation, right? So we kind of think about in 2 ways. Like sometimes there's new markets, like non-human identity is something we talk about a lot these days, right? And, this is like, we're meeting a lot of companies that are helping customers manage API keys and containers and secrets management and even AI agents. That seems like a new market. It's not necessarily a new concept, but the idea that we can kind of build a platform around NHI or machine identity, kind of a new market, that's exciting. And there's a lot of venture dollars flowing into that because there aren't new markets in cybersecurity very often. You got to go back in time. Maybe API security was a new one. Obviously, like cloud security and that whole market around CSPM and CNAPP was a big new market. But think about it, like they don't come around every year. It's every 5 or 10 years, right? These new islands of opportunity come around in security. Maybe security for AI is one that we can talk about that's new. It's a small market, but a new one today. So VCs get excited about that because, look, the outsized returns I was talking about often come from these new markets. Not always. So the other way of looking at market is, hey, is this an existing market? Like PAM we were talking about. PAM is not a new idea, right? There's been a lot of change and a lot of cloud native and a lot of the way we think about application access has changed, and identity has changed. So that's a perfect example of a market that's exciting for us to invest in, but is not a new market. It's like a replacement market. Maybe those products have been neglected, and so I think when it comes to like the very first principles thinking, team number one, market number two, and then the second order bits, we'll get to if we can say yes, like check box on those first two. But if we can't, move on.
I'm slowly having flashbacks to 2 years ago when I was out, trying to raise money and, hearing all this from VCs. And now, like, hearing it from you, I'm like, you know what, this makes a lot more sense and it's easier to hear on this side when I'm not on the other side of the table. Like, got the freaking check, man. Hey, everybody, it is going down December 9th through the 12th in lovely Grapevine, Texas. You got to be there. You know what I'm talking about. Gardner IAM conference. I will be there. Samir will be there. There'll be a ton of identity nerds hanging out, networking, and of course, grabbing selfies. So listen, make sure you go. I'll be doing the talk on the panel. Come find me, grab a selfie. We'll see you there. So, kind of going back to like the different models, right? I think, and I fully admit I'm going to die on this hill, right? It's the type of person that I am. But I think this market is an interesting nuance or difference when you look at it, to where talking about how the different playbooks between PE and VC, totally understand it. And the way you explained it is like, it makes perfect sense. I get why the two would cross. They're playing two completely different games. But I look at this market, and I could probably go back in history and find other times when market conditions kind of created this type of environment when you're having, specifically, I'll take identity, when you're having a swing on multiple fronts, meaning this, right? We're swinging the pendulum from best of breed over to platform. That's number one. Number two is, as we're swinging that, what's happening with that is that means customers are less concerned with, less concerned with having like 4 or 5 of the best tools. They're more concerned with having the right tool that's delivering the right value at the right time. So that's absolutely what I want. Mm-hmm. We've got the money basically not being free, right? That actually costs now. Right? There's an actual real cost to borrowing money, right? We're not sitting in 0% interest rate environments anymore. And so you look at that, it's like, okay, so therefore we've got to be more stewards of that. And so when you look at that and you're saying, okay, well, I'm looking for opportunities. If I'm looking at a market that's shifting in a time where access to capital is a little tougher, so I've got a plethora of companies across. Some of them just aren't going to make it. To your point, you use that and say, okay, they don't have the right team. They don't have this. Some of them do, but what they're going to run into is, I started a model where it was grow, 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 grow. Now I'm in a model where I got to manage burn, right? But I'm in an area where sales cycles are already long, but now they're even more elongated because as I'm talking to customers, they want 5 features, only have 2, right? And so I just see this area when you start to look at the math and go, okay, you need 5 features to get this sale. You've got 2. This company over here is in the same position as you. They've got 2 complementary pieces, right? And you look at it and go, both of you guys aren't going to finish this race at the same time. Right? Like you're just not. Like we're looking at burn rates. We can measure it out and go, okay, in 7 months, you're going to stop. And then 4 months later, or 18 months, whatever it is, you're going to run out too. Why? Because what you need to go raise more capital, you need to see growth either in your product or in your market to start to see new logos, whatever. I need to see some kind of action taken, and you're not getting there. So I think that it'd be interesting to see somebody who kind of says, all right, well, I'm going to take a little bit of VC, a little bit of PE. I'm going to come into this market and I'm going to make some things happen, right? I'll take 2 or 3 of these companies and I'll have to do a little PE, which is to manage the burn rate. It's like, hey, not everybody's coming across. So yeah, we're probably going to take the best out of all of this. We're going to put together the best product and out of there, make the best teams and put it in there, right? So it's a little bit more hands-on approach. But I just really think coming out of that, what you're going to see is you're going to have, somebody has to build the mid-market platform, right? It's going to have to happen. And I know that from talking to customers and looking at it, because not everybody's going to take a SellPoint, CyberArk, Save, like there's big enterprise companies that can handle having all those big platforms, but these smaller companies, you're talking less than 10,000, identities, like they have these same type of problems, right? They want SaaS. They don't have on-prem. They're all cloud. They're all SaaS. Most of their stuff is standardized. You can come in and deliver it a whole lot quicker, but I need all these features, right? And I think it's going to be faster to enact combine than it says, okay, you individually go build and grow and get there, or somebody to come up and go from scratch, I'm just going to build it and try and outpace everybody that's already there. So I think it's a unique opportunity. It's not one that I think these conditions won't always apply. So it's one of those areas that I think unique enough that's like, okay, we could take advantage of now our little mid-market monster platform that we invest in now that we've kind of created 5-7 years from now is kind of the de facto player, and there's a return. So it's a crazy idea. It's like I said, it's unique. That I don't think it would play to all of the models. So it's just going to be interesting to continue to watch, right? I think a prudent investor would always probably say, well, I could just sit back and wait because in 12 months, it's 30 companies right now. It'll probably be 10. And then I just kind of, wait, pick my battles and invest, at whoever makes it out of this. So I could see that playing devil's advocate as well.
I think customers would love what you're describing, going back to the customer point of view, where, look, especially if I'm a mid-market customer, bundling has always been a good trend for mid-market. Why do I got to buy from 10 different vendors? Let me buy from one or two, or even outsource some of this to an MSP or MSSP, which, by the way, we're seeing some really interesting AI assisted methods to kind of remove the human element of that and kind of automate it. So I think mid-market is actually super interesting, and not a lot of cybersecurity companies. It's been overlooked by a lot of cyber companies. But what you're describing requires a lot of operational hands-on. When these companies get merged together, there's a lot of work that needs to get done to figure out, which products to focus on, which costs to take out, how to do that professionally without firing a bunch of people unnecessarily or in a bad way. And that's dirty work, man. Like, you got to roll your sleeves up, and there's a lot of, just lazy investors out there that just want to place bets. So maybe you're onto something, and maybe the Jedi Ventures first deal will be a roll up in market identity space.
Hey man, listen, this is why I went to Amazon, man. I don't like easy problems.
Yep.
Yeah, we both ex Amazon. But Rama, you mentioned a lot about just pivoting a little bit, right? You talked about looking at 1,000 companies a year, right? I think our viewers would love to hear the day in the life of a venture capitalist, right? So one is you're sourcing deals, you're sitting on board. So tell us a little bit about day in the life of, week in the life of, if you don't mind.
5:30 hot yoga, then you're live.
That's right. Cold plunge.
To David's point,
Check
I think
the
sometimes
Yankee score.
Yankee score. No, I was saying sometimes when you're from the outside looking in, and you go to Sand Hill Road and you go and visit the VCs and you do your thing and you have them on your boards. There's some misconceptions to David's point. Is it hot yoga at 5:30 and checking the scores and just chilling out? No, it's not, right? So we want to know what it takes to be a VC, not just what it takes to be a VC, but what your life is like. I mean, and not so much about the levels within a VC, like associate level versus a partner level, but more about, how do VCs, so.
For sure. Look, I think I'll start first at like the year-long view of things, because I think it's important to kind of zoom out. There's a lot of VCs and a lot of money out there. It's a commodity, and I have no misunderstandings about that. So we at Menlo, me as Rama as an investor, need to figure out how to differentiate. Like, we're in a competitive field, and this is a sales job. I'll tell you a funny story. I've got 2 kids, and my wife is a winemaker. So she's got this cool job where she gets dirty and she, comes home with dirt on her fingernails. And my daughter, when she was about 4 years old, was pretending to be mommy. And she's like, I'm going to the winery. And all our friends were laughing who were over at the time. And one of my buddies asked my daughter, what does daddy do? And without skipping a beat, my daughter said, daddy sells money. And I said, what? I'd never used those words before, to describe what I'd done, but she was right at a first principles level. We're out there selling money. That is our product. So when I look at the year of work that we have to do ahead of us and what we want to get done, it's evaluating those 1,000 companies, but it's really to get to the 1 or 2. We're not a high velocity shop. We want to do 1 or 2 investments per partner per year to kind of build up our portfolio of the best companies. And how do we get there, right? So I think you can be reactionary. The old school model was to sit up on Sand Hill Road and have founders come to you. Or, you can go out there with a thesis in hand. For instance, right now we've built out a non-human identity thesis. We've built out a security for AI thesis, a thesis for AI for security, which I can break down, and those 2 things are different. and have an opinionated view on where the market is going and a thesis around which companies or which spaces to invest in. We're not always right, but we want to kind of have a view of the market and what's going to change. And that's sort of a thesis that's always evolving based on every conversation we have, every customer we talk to, every company we speak to. And with that, armed with that thesis, then we can go out there and proactively say, okay, here's the 5 or 6 companies we want to go meet, or we're not seeing a company in the space. Let's send into Menlo Labs, which is our incubation program, and start a company around this space. Let's take someone out of Palo Alto Networks or Cisco or wherever, team them up and start a company if we're seeing a gap in the market. But that type of activity is useless if you're not sort of looking at the horizon and trying to figure out where the market is going. We're not always predicting the future correctly, but at least we want to be opinionated around where the puck is going, right? Now, what does that mean week to week? Mondays, we're all here in this Menlo Park office, sitting together in a partner meeting and talking about which companies and which opportunities are kind of near the finish line. And we'll oftentimes have companies and founders present to us on Mondays. Monday partner meetings are kind of the big meeting, the big meeting on Mondays for most VC firms. Founder will come into a conference room like this and pitch, my partners on their idea and how much money they're raising. And by this time, by the way, we've done a ton of diligence, right? We've hopefully spoken to their customers. We've done some market sizing. We've looked at we've built our own version of their plan to kind of think about what their revenue is going to look like over the next 1, 2, 3 years, how much capital that's going to take. We've spoken to competitors, right? We've done a lot of work that gets put into a deal memo that everybody reads here, listens to the presentation, he meets the founder, and then we vote, which I think is really interesting. Sort of some organizations out there are kind of consensus driven, where it's like, hey, the loudest voice in the room is going to decide how whether or not we invest. Here, we've decided, look, we're going to vote. Everyone's got a voice. We want to kind of understand the data, but we want to hear the presentation directly from the founder. We're going to vote on whether that deal gets done or not. And that all happens on Mondays. And the rest of the week, Tuesday through Friday, we're out there prospecting, going to conferences like Black Hat, trying to learn about the market, meet companies, hopefully before they're actually fundraising, right? This is a relationship business. Going on someone's board is like, I've heard this sort of analogy around getting married. You're like, it's actually harder to get off someone's board than it is to get divorced. So, it's really a long-term relationship that we want to start even before companies are fundraising. So a lot of that, non-Monday work is sort of figuring out, okay, who are the people we need to know? Who are the, smart conversations that we want to have to influence where we want to invest? And that last step is the sort of presentation on Monday, where they come in and hopefully we invest. So hopefully that gives you some, idea of what we're doing. And it's a lot of, there's a lot of kissing frogs, out there. And, you got meet a lot of companies that we're not going to invest in. But hopefully we can, if it's not a fit, do it in a productive way where they're learning something from us. I'm always, humans don't often like feedback, and people say they want feedback, but they really don't. I think the worst thing a VC can do is sort of turn someone down without giving them feedback. Like, we might be wrong. In fact, I hope we're wrong, for the founders' point of view. But, if we see something that didn't fit our model, I share that, and sometimes that's a risk that people don't like, hearing. That's a risk I take because people don't like hearing that sometimes. But I think we owe it to them. They're pouring their lives into these companies. And, if we're not going to invest, the least we can do is tell them why.
Yeah, man, it's going to come up again, Samir, like lessons from Amazon.
Yeah.
As much as I hated my time there, really some good stuff. But about feedback, right? I think, to your point, most people don't like getting feedback, but I specifically think it's because people don't know how to give feedback in a constructive manner, right? It doesn't have to be it doesn't have to be negative. It doesn't have to be awkward. It is a tense, right, conversation, but you can deliver it in such a way, right? You keep it data driven. You keep it, to the point. It's like, hey, here's what I saw. That wasn't quite this. It's measured on this level. Here's what you can do to improve that type of thing, right? It's all about being constructive. I want to tell you something that you can take away and go get better on. And I think it's, when giving feedback, there's a lot of responsibility on the person giving it to go, okay, not just to say, oh, well, I think it's an ugly shirt, right? Okay. You think it's an ugly shirt. So what? What is that? Why is that important? Well, it's important because I know this person wants to, dress well or be perceived in a certain way. And I think it's ugly because it does this. What are ways they cannot be ugly or this, whatever? Like that thought process, right, takes time. And a lot of people don't do that. They just go, Rama, that's an ugly shirt, right? And now it's like, well,
Hey, this is Dodger Blue, man. I wore the wrong color today.
It's how you give the feedback, but I also think, to Rama's point, right? I mean, sitting on the board of a startup where maybe it's brilliant engineers that don't maybe understand the market dynamics. He's got him and Menlo Ventures and other ventures, they're looking at the market broadly. They're hearing about other competitors. They're hearing about from their CISO network, et cetera, right? So I think as founders, we also have to be able to accept that this is a marriage and that feedback is going to continue coming, right? And then I haven't been in one of those board meetings, Rama, because I've been either on, presented to public company boards, or as right now, Balconati, we're safe funded, so we don't really have a board. But I would imagine those board meetings can get contentious when people have disagreements, right? And so being able to kind of, disagree and commit, as David mentioned, our times from Amazon, is super important. I think, Rama, I know this is interesting, but that founder market fit thing is still sticking in my head because I think it's not just about the founder having experience or being very deep in an area, but I'm sure that, Rama, you're looking at these founders and saying, are they going to be, self, what's the word? They're going to understand their own personalities and their weaknesses and strengths, right? They're reflective, if you will, so they can adjust and pivot based on responses versus being almost closed off, right? And that takes a lot of coaching. So I guess there's a question here somewhere. Do you feel like you're being a therapist sometimes to the founders because you're sitting on their boards?
Yeah, it's a unique, relationship, and my goal always is sort of to be their first call, right? Whether, I say that whether it's good news or bad news, and I think it comes back to that trust, topic. I don't think any board member is going to have the answer every single time they pick up the phone, but my aspiration is to sort of be that first call and be there. Sometimes you got to remind founders, the lows aren't as low as they think, and the highs aren't as high as they think sometimes, so to kind of put things in perspective is the best thing we can do. Look, we're kind of like a pattern matching machine, right? Like we've got 47 years of history. We've built successful companies before. We've made mistakes, before. And my job, when I talk to founders about coming onto their board or taking an investment from me and Menlo, we're going to make mistakes together is my philosophy, but shame on me if they're making the same mistakes that our, hundreds of portfolio companies have already made, whether it be go to market or hiring or whatnot. So my job is to sort of be an API to that pattern matching machine and give them all the data, right? Give them the benchmarks of how successful companies grew, what they did, when they started using resellers, when they went overseas, when they, how they handled pricing and packaging. It comes in many different forms, but giving them that information, I think, is the best way for me. And open doors, open doors to customers, open doors to talent that they need to kind of scale their organizations. Those are the things I think really great board members, I learned from my mentors early on in this business, the work happens in between the board meetings, not at the board meeting. You don't want to be that guy that's like, why isn't that, chart up and to the right? It's totally useless, feedback during a board meeting. But what's helpful is like, hey, like, look, let's lift our head up and think about where we want this company to be in 12 months or 18 months. How do we get that next successful round of financing? How do we partner with the right, companies to kind of make sure that we have a big brother out there in the field? All those types of things take a lot of time and a lot of doors to be open. And that's what I think the best investors do, like day in and day out.
I know we're almost out of time. Rama, I would be very jealous of people that took money from you. Because I have a feeling that, so David and I are going to talk about our startup and call you tomorrow night, right? Just letting you know. No, the big thing is that
Let's do it.
I feel like, places like Menlo Ventures and other VCs like that, like Andreessen and big names like that, they don't just support from that angle that you mentioned, but I've also seen and heard that, say I'm starting an identity company, right? And you've got a portfolio of ride-sharing companies or AI companies. You almost do the founder matching to say, hey, they're building this. Is this a problem that you're facing in your health tech startup, right? Around identity, right? And I love that you guys do that. So I just want to close with that's one of the real values I feel to our audience from raising money from people, not just that are well known, but will work for you, right? I think Rama said it right. The board is there to support the CEO and make him or her successful, and the founding team, not just the CEO, right? It's not the other way around where it's mom and dad having a dialogue around why did you come home late one night, right? So I love that. So thank you for that, Rama.
Yeah, look, I mean, I think our job is to help these companies scale, help them grow, be there, during hard. Building companies is hard, and it takes a special type of maniac to start a company and really scale it. And our job is to kind of be there, open doors, help them, be there not only, to high five them when we ring the bell, but, be there when, the hard times come. So I think I wake up every day and try to, remind myself of all that.
That's awesome, man. Listen, now you've created another soft spot in my heart for VCs because after 2 years I was like, they're all the same. Screw them. I'm just kidding, man.
Well, look, congrats to you guys on this pod. I mean, I think it's such an awesome space you've created and community, and I'm just really glad to be a part of it, small part of it today.
No, man. Thanks so much, man. We enjoy it. It's been fun getting a chance to talk to people like yourself and just have conversations, man. It's been super cool. Thanks for taking the time. This was super awesome. I will make sure that we do something, we do a nice follow-up, right? We've been planning probably sometime next year to do like a live show out on the West Coast. So I'll definitely keep you in the loop, man. And if we put something together, it'd be great to have you come out.
Nice. David, Samir, thank you guys. Go Yankees.
Oh my gosh. No, I'm cutting that part out of the pod. All right, guys.
Bye.
This has been another episode of the Identity Jedi Show. Make sure you like, rate, subscribe on whatever platform you're watching this on. It all goes a long way. Make sure to subscribe to the newsletter, theidentityjedi.com. And until the next time, be good to each other, be kind to each other, love each other. We'll see you guys on the next show.